Okay. I've lost my control panel. Can you hear me?
Yes.
Yeah, you still hear me?
Yes, can still hear you.
That's fine. I've lost the questions, unfortunately.
So Simon, we're actually live, and so
we are live. There we are. I'm just getting my questions and chat. So welcome everybody. It is Simon Campbell here from Round the Clock Trader. Welcome to our live webinar. See, we already had a question, someone asking, are we live? We are live. It is 5 p.m. London time, 6 p.m. European time, and evening time, morning time, whatever you are. So welcome to our second session of our 4-part Intelligent Investor Workshop with Fineco Bank and Round the Clock Trader. Round the Clock Trader is a brand that I've been running for many years. So what we're going to have tonight is really one main presenter who's not me. It's a man called Adam Harris. He is our main coach instructor, a fund manager, professional trader, and he'll be coming in just 5 to 10 minutes time. We also have Antonio de la Ana, from the head of business development at Fineco Bank, who will be here to help us with the technology and to answer any questions specific to the bank and the platform. So welcoming you to as I say, this second part where we're going to be focusing on technical analysis. What I'll do is recap, first of all, just to put you in the picture, that you know where we are and make sure everybody is clear on what we're going to be doing tonight. So first slide, just to give you a little bit of background about me, founder of Round the Clock Trader, as I say, the brand that offers these webinars and multi-speaker events for traders and investors. Been doing that for about 7 years now. Born and raised in Scotland, some history in working in the Royal Bank of Scotland outside Edinburgh, and since then I always run my own business doing private investor seminar businesses and expos and workshops. A member of this, an associate, it sounds very grand, an associate of the Chartered Institute for Securities Investment. I had to do this for a role I played with a company called VectorVest, which is an American portfolio securities investment platform. I did all the exams, none of it, of course, which helps me to pick stocks in any way, but it does let me know all the rules and regulations. Set up IX Media, which is the company which runs Round the Clock Trader brand and London Investment Week, and of course the London IX Investor Show, which we'll do at the end of the year if we're allowed to do shows again. Adam Harris, our main speaker, trader, fund manager, mentor, and coach. I'm going to let Adam tell you a bit more about himself, but suffice to say, I've known Adam for about 5 years now. We've worked together many times, which is fantastic. Live seminars and online at these workshops. So Adam will be taking us through his setups, have a look at the live platform charts, and giving us some insight into how he trades, how he uses the charts for his trading. And there, Antonio. Now, this is an old photograph. Forgive me, Antonio. This was before the beard came, but Antonio here is going to help us with any questions we have about Fineco. Just out of interest, if you are already a customer, just let us know in the chat box. We get to know if you're a customer or not, and are you in the UK or are you from overseas? Because I do have to say that we will be offering you the chance to sign up for a free account to Fineco. We'll go into all the details, the features of what that involves. It is unfortunately just an offer for UK clients tonight, unfortunately. So good to know where you're from, though. So let us know in the chat box if you can. Quick bit of compliance. This presentation regarded as educational guidance, helping you understand the principles of portfolio management, stock selection. We don't want you to think that anything we're talking about tonight is a solicitation to buy or sell any stock or make a position on any market at all. We're doing this as an educational event, so not to be confused with any financial advice at all. So the agenda for tonight, we've got around about 90 minutes. We tried to squeeze it into an hour last month, but it was a little bit tight. So we're giving ourselves 90 minutes, and I hope you can stay with us for the full 90 minutes. A little bit of an introduction and welcome, which I'm doing now. Welcome. I'm going to tell you a little bit about the 4 parts of the workshops and what we're trying to achieve, what you may have missed if you hadn't attended last month's session, and what you can still join tonight, and the 3rd and 4th part, which will be on the 23rd of June, and I think the 7th of July. I need to check the date, early July anyway. So today we are looking at the intelligent investor. What is an intelligent investor? I'm going to tell you a little bit about a very cool tool called the Stock Screener, which is available as part of your Fineco account. And then I'm going to turn over to Adam, who's going to get jumping straight into the technical analysis for trading, looking at the theory of charting, why he uses charting, why so many investors also do these days, and growing. We're going to look at trend lines, how to spot a rising and a falling trend, support and resistance levels. Some of these are basic things, but Adam's also going to be doing a whole heap more in there. So these are very much just the basic sort of touch points. Then once Adam is completed his session, which hopefully should be around about 6:15, we will take some questions. We'll all answer them. We're going to tell you a little bit about the Fineco account, and then we'll hopefully be able to let you go at 6:30. So there we are. Let's move along and just tell you, this is a screenshot I took earlier today, just the webinar page on the Fineco website. Right up at the top here, 9th of June, that's us today. This is the part 2 of this event that we're running. Now you'll see part 3 on the 23rd of June, and you'll see part 4 on the 7th of July. I was right with the date. But don't wait just for these to come though, because all these webinars are available for you. Trading stocks with Fineco, how to set up charts and place orders. Some of these other events are fantastic events run by the Fineco team themselves, giving you instruction actually on the platform and what buttons to press, and just really the sort of the practicalities of using the services that they offer. There's also some other people, live trades and strategies from different contributors around the world as well. So keep a check on this page. Join as many events as you can. So what we don't want to do is confuse you too much, but what we do want to do is to make you a competent investor. I hope most of you joined us last month for part 1, but if you didn't, and if you did, excuse me, I'm going to just repeat 1 or 2 of the points I made. But for those joining us for the first time tonight, we just want you to understand what it is we're trying to do. Are we trying to make you get rich? Well, no, not really. That's if you get rich on the back of it over the longer term, great. But really, what I define as a competent investor is someone that's in control of the portfolios, building wealth in a measured manner, one that doesn't cause you to lose sleep at night, one that doesn't want to cause you to take big risks, and maybe see big drawdowns, big losses one week. That's betting, gambling. We want to stay away from that. If we're going to build a portfolio that is going to be reliable and it's going to be there in 10, 20 years, whenever we're going to need it to act as a retirement portfolio, that is, I think, the aim. So building wealth over 1 to 2 or maybe 5 to 10 years in the markets. And if we're going to do that, it's really important to understand what type of investing or trading we're going to need to do, and that really depends on the time frames. So I define trading as something that's short, maybe sort of 1 to 2 hours, or maybe 3 to 4 days at the most. Investing tends to be weeks to months to years, in fact. So that's it's a bit of a grey area, but that's my understanding of it. And we want to build a portfolio that can achieve different goals. One is to continually grow in terms of capital value, but you want it to be able to pay you as well. You want to make an income from that money. You want to make it work. And the way you want to do that is to invest into dividend stocks. So you will look at how we can bring them out of the system later on. And we want to be in control of our own investment portfolio. This is what I was saying at the start, just the control and knowing where you are, being your own fund manager, being able to monitor and assess what's going up, what's going down, and how they're all performing as a whole basket of stocks. And of course, we want it to outperform the market. If we just want to put money in and just goes up with the market, then we can just use any fund for that. It'd be quite simple, but I think we can help you to improve the market over the market performance itself. Things to keep in mind, some basic rules: avoid money reducing value by sitting in bank accounts. Now, this plays into the idea of leaving your money in a bank. Savings are very, very low. Return at the moment, the interest rates have been historically low. This might change this year and the next. There is a risk of inflation going up. But at the moment, if you put your money in the bank, the inflation that is going to occur outside of banks is going to make your money worth less as time goes on. So you want to put it into stocks or commodities or some sort of investment that's going to go up faster than inflation. You want to build a diversified portfolio. I mentioned diversification before. That involves investing in several uncorrelated investments. So when one investment might decrease in value, another one might rise. So overall, the net effect on your portfolio will remain stable. That's what diversification means. It's not having all your eggs in one basket. Normally, most investors seem to think 15 to 20 is coupled with. Probably 10 is enough to find some diversification to get started in the first place. You want to diversify across companies. You want to diversify across different sectors. So you might want to look at tech, pharmaceuticals, some traditional retail, or all these different sectors that there are. But there are all sorts of different ways to hedge the protect the value of the portfolio. Indeed, country diversification is another tool that you can use as well. You can invest in the US, UK, EU. So if one particular bloc might suffer economic shock, you won't be totally exposed to all the companies that trade out of that region. This is where Fineco can help you, because it's a multi-currency account, and you can trade and invest in domestic markets and domestic currencies. So you can invest with dollars in the US, invest in euros in the UK, euros in Europe, and pounds in the UK, obviously. And you can move your money. This was always a big problem before. You used to have to change money into dollars, buy your stocks, and then change the money back. And all the time, not just were you exposed to the risk of the investment, you were exposed to the exchange rate as well when you brought the money back on shore. And that's something that in the Fineco platform and the multi-currency account can reduce that risk further. There's also bonds, commodities, and forex markets, of course. Forex markets work slightly differently to the stock markets, but we're going to be looking more at stocks this evening. I said at the bottom of the last 2 points here, I said develop a routine for monitoring your portfolio daily or weekly, and develop a routine for searching replacement stocks. These are really important. As you go on, you will find that the most successful investors will be the ones that don't just buy the stocks and then leave them. They will buy the stocks. They might not check them every single day, but they'll certainly be monitoring the progress and be ready with a sort of a backup watch list of replacement stocks that they might want to replace something in the portfolio with. You want all your stocks to be rising. You want all the prices to be trending upwards. And if one stops going upwards, starts to plateau or indeed go down, you want to ask yourselves how long you want to hold on to that stock. And if it keeps going down, you want to replace it with one going up. Searching and monitoring, how do we do that though? What are the two ways that we do it? The most traditional ways that you've probably heard a lot about are fundamental analysis and technical analysis. Fundamental analysis involves looking at the intrinsic value of companies, the data, the financial performance of the companies, the markets they're operating, all these real measured data, and it's not just data, it's financial ratios, but it's also having an understanding of the market that it operates in, whether it's a sort of a top-down fundamental factor that's affecting the price, or whether it's something from the bottom up that the company's doing wrong, or you have a bad CEO or anything like that. These are all fundamental things, and a lot of investors spend a lot of time drilling into getting to know the companies that they invest in. Technical analysis involves more or less ignoring all of that and looking purely at the price, the chart, the history of the price over a period of time, whether it's a few days or a few months or years, and understanding how that price is affected by the market, the trades in that stock, how other fundamental factors can impact that price itself, and effectively looking for trends. And this is what we're going to be spending much more time on tonight when Adam gets into this technical analysis, commonly known as charting. So charting is technical analysis by another name. We are also going to introduce you to a great tool that comes on the stock screener on the Fineco platform called the Stock Screener. It is available through the browser. When you open up your account, you just click onto the shares, and then at the bottom menu, you'll see a tool called Stock Screener. It's a fantastic tool, and it gives you the ability to filter down a huge universe of companies. If you imagine a huge spreadsheet of thousands of companies across all the different markets, the UK stock market, the European stock markets, the US markets, you've got, I don't know how many, must be 10, upwards of 10,000 in total. How do you narrow down? If you've seen a bit of news on the news, or somebody said, have you seen this new company or this new product? How do you think, I want to go and look for a company that's exposed to that sector, that's working in that area? Then you can use the stock screener. If you see on the screenshot here, there's media and entertainment. American companies which get profits from cinema and internet TV. Well, it could be simpler. So you want to think about a Netflix type company, or maybe you want to look for the next Netflix. That is where this stock screener will be able to throw up companies that meet that criteria. As I say, it's free with your account. It's got not only fundamental data and filters there, but it's also searches and filters on technical data. So you can set parameters to say, I want to see stocks that have risen over the past week and month, but maybe they've fallen from a high 6 months ago. There are all sorts of different parameters. A great undervalued tool that comes free. Lots of companies produce this tool and sell it as a subscription, and a lot of investors use these. You get it free with it's fantastic. You'll be searching on the stock exchange, the companies listed on, the sector, as I say, the fundamentals, the performance of the price, and the technicals. I'm not going to go into all this in too much detail tonight, because we're looking at technical analysis in the main bit, to mention just a few of these ratios that you would search on: the return on equity, return on investment. And again, if you want to drill into more of these, there's house webinars that Fineco will provide, giving you more information of these. On the technical side, you can search for the simple moving averages, the crossing of these moving averages, so you can ask for how many companies have seen their longer moving average cross their shorter one in the last 10 days, for example. All sorts of different parameters. I've counted 36 so far in terms of the amount of screens, filters there are. Great names, I love them. God Save the Queen. I think that one relates to UK stocks. We've got Warren Buffett. Now, these will be tremendous long growth stocks and undervalued stocks. And there is one called value stocks there. COVID-19, very current, looking for defensive companies against the pandemic. Also potential profitable companies to come out of the back of the pandemic. So lots of great filters there. Skyrocketing prices, bull trend, tech and internet, all sorts of different filters there. It's a great tool, one that I love using. So finally, before we hand over to Adam, just to leave you with a couple of thoughts. Don't underestimate what you're capable of as an investor. Even though you might be here as a beginner, you have it in you to make this work. It's not rocket science. You don't need to have a degree in finance to become a successful investor or trader, if you prefer to be more short term. But do learn at your own speed. Don't rush into the market. I think it's one thing I've learned hosting a lot of these webinars and events. People are eager to get in. They see the adverts, they see the chaps with the Ferraris saying, trading Bitcoin. The market's very good at taking the money off you, and the market players are very good as well. So you can lose money quickly. So you have to be careful about how you approach this and what you actually invest into and what sort of leverage you use. It's probably better to leave leverage to the side if you're just getting started until you're more comfortable with your investments. Have realistic expectations. Again, more or less similar to the last point, just don't expect to give up the day job within 3 months. Become successful with what you're doing on the side, and once you feel confident, if you want to take it full time, some people don't because it can be boring, but that's up to you. But don't rush it. Take it slow, and you will build the value over time. Don't become emotionally attached. This is a big rule that many people get wrong. They become attached to an investment, a stock that has performed well for them, and they might have made a lot of money with this, and they don't want to let go of it. But if it does start to fall down the chart, let it go. Buy it back again later if you want, if it starts to return. These are sort of elementary mistakes that it's your emotion, it's your mind getting in the way. And there's thousands of webinars about trader mindset and psychology, which are very important to become au fait with as well. Work with a quality regulated broker. It sounds a bit like I'm biased, which I am tonight, but Fineco Bank are a regulated broker, and they are a proper broker. Many of the companies that you see that describe themselves as brokers these days are not brokers. They offer what's called spread betting in the UK, whereby they have their own market. They set their own market, their own market prices. There's a spread which can sometimes vary. The prices themselves can sometimes vary from what you'll be quoted on the real stock exchange. So for all these reasons, make sure you're working with a regulated broker. You've got some protection through the financial protection scheme, and you can be assured that your orders will be processed and you will get a fair service. In fact, a very good service, and that's where I think something like Fineco at your side can make your whole investing process much simpler and much more relaxing. You have a trust of the big firm behind you. Antonio can tell you the history of Fineco, been around for many years, very big in the Italian stock market, listed themselves, so you can even buy their shares. Track and monitor the portfolio on a regular basis. Don't become too nerdy about it, but do set yourself some time just to keep a check on things. You want to try and filter out the noise, though, if you can. These broadcast channels like CNBC and Bloomberg, they want you to be up and down. You watch that every day. If something's happening every day, they have to fill the airwaves. So, but try and filter out a little bit of the noise. Of course, the new sort of trend for getting investment advice on the Reddit forums and Twitter and Elon Musk, it's all a little bit nerve-wracking. They're all manipulating the market in one way or other. So make sure that you get news from trustworthy sources. So Fineco Bank, introducing Fineco Bank, as I said, it's a great platform. We'll talk about this a little bit more as we go through, and that's the PowerDesk platform that you can see on this presentation slide here. But that's all from me. I'm going to turn over to Adam now. Thank you for listening, and I hope you enjoy the session tonight where we get stuck into the charting and the technical analysis. Any questions will be around afterwards to answer all these questions. So Adam, how do I hand over to this? Do you take that yourself?
Let me have a look. Yes, Antonio?
I'll take care of it.
Okay.
Thanks, guys.
He's the DJ in the background. So Simon, that was great. So, and again, there was actually some overlap with things that I wanted to mention that you stated there. So that's good, because it's just reiterating that approach. I think not being influenced by somebody else. I mean, I find it interesting because a lot of people are very mad at Elon Musk for what he did with Bitcoin, but Bitcoin's been around for years and lots of people have been raving about it. And some people only took the plunge when he did. So they kind of, instead of making that decision independently, they kind of followed. So, and I feel kind of in that respect that, they should have known the value was there before he did as well. So welcome everyone. Sorry, excuse me. Welcome everyone, and you should be able to hear me. Sound should be good, and yeah, there we go. So it's very hot. So I'm working in the office at home, and of course, typically there's no airflow, so the dogs are busy cooking in the baskets on the floor. And anyway, I'm getting a bit of fresh air every now and again. So what I would like to do with this is introduce how technical analysis, in essence, can be used to help visually confirm that we're looking at a very high value or at least a really nice trending stock. So on the agenda, obviously, Simon's already mentioned it. I was just going to talk a little bit about some of these concepts here. I'll go through them individually and want to kind of give you a broad sense of that. So last time we spoke about just actually quite a lot of different things. We had a look at a variety of different stocks. We're going to do that again. I'll go onto the platform. And I also want to highlight, ones where how do we have that confidence that something is generally worth our while? And I think also what I really want to do, and we've also got parts 3 and 4, I want to talk a lot about how we choose our entries, because timing and entries is a big factor as well. And so this was something, that Simon was saying earlier. If it starts to fall, if there's a point at which it starts to look like it's decreasing its value, its value, if it's starting to underperform. And I think it's important to compare it to others. So if we have a stock, for example, that we think is performing well, and then we find that it's underperforming, we should look if that is a market-wide kind of sentiment, or if it's this one in particular. And examples that might be something like General Electric, which has been around for a long time, which is it's one of the constituents of the Dow Jones Index, and they've been underperforming for not historically they've been performing well, but underperforming for the last few years. And so that's an example of one where no matter how big the name is, if it is underperforming, if we use BP or Shell as examples, they're not really worthwhile, but a lot of people feel that because it's oil, it's got to work, and therefore it's worthwhile. So, sorry, just a brief introduction to me. Yes, this is my second career. So I used to be in the film business and doing a lot of technical stuff there as well. I probably spent 3 or 4 years kind of all over the place before doing a lot of different types of education programs to build up my skills before I kind of landed on trend-based trading. And trend-based trading was really the key thing, because trend-based trading really is about learning how to identify the right type of conditions. And once you do that, then automatically the probabilities of success are a lot higher. And it amazes me how people still tend to make irrational decisions. And so this is why we need the training. This is why we have the webinars, because what we have to do in a way is kind of talk about some of the decisions seem counterintuitive to the newer trader / investor, but over time it becomes the other way around. After a while, you can't imagine that you would buy a stock when it's kind of very much overextended to the upside, when it's overvalued. You'd be much more interested in buying it kind of at the bottom. Okay, so I spoke about kind of identifying a trend. There are a couple of different ways in which we could do this. We'll start with the third place one, which is using trend lines. So I tend to not use trend lines these days. I've kind of dropped it. So there's a list of different technical tools that we have at our disposal. And trend lines are very popular, but because something is popular doesn't necessarily mean it's reliable. And so where I'm coming from here is I'm looking at if I had to strip everything away so that I just look at price on the chart and then start to build up from there, what are the things that I absolutely must have that are very reliable, or as reliable as can be? And then I can throw other stuff on top of that. And other stuff on top of that might be Bollinger Bands, or there might be volume spread analysis or something like that. But it has to deliver to the user. It must demonstrate frequent returns, meaning it must show that it works consistently, and that's a big thing. So trend lines can be subjective, meaning where do we connect them, where do we draw them? They expire once price moves past them. So generally speaking, once kind of price has kind of tapped it and then eventually moved on at some point in the future, that trend line just fades away. And so also the way in which price reacts to them, although we can see it often with channels, and indeed, I can see that once I place the trend line after the fact that it's kind of responded to that. I'm not sure how, I've not always felt that it's responded reliably enough to a key level. Whereas I find with horizontal levels, which we'll talk about later, I find price respects that a lot more, and actually that makes more sense because it is price-based. So when I just said they can't be used to predict price action levels indefinitely, what I mean is that generally speaking, their value will expire. But they can be good for identifying short-term channels. So we also have to accept, because it's kind of tricky, what we're doing, during this activity, if you want to know why this is kind of so difficult, it isn't actually, the concepts are relatively simple. It's just tricky to apply them because it involves so much emotion, because it's got, money, security, it's got our future hopes and dreams attached. And that distorts our decision-making process. And so we're trying to look for sort of solid ground when it's almost like navigating quicksand a little bit. So that can be a bit of an issue. So another option that we can look to identify kind of trends is to look at the moving averages. So in my case here, I've got a 50, a 20, and a 10 simple moving averages. Okay, it can be anything. It's just that this is sort of old-fashioned. The traders back in the day in the 80s, 70s, and 80s used to chart before they were kind of using computers. They were plotting their own moving averages, and so I kind of just have gone with a sort of a simple moving average in that respect. And it's really good because generally speaking, price will be kind of bouncing above the moving averages when it's trending well to the upside. And if it's a downtrend, it will be kind of cycling underneath the moving averages. So it's really when it gets on top of the moving averages that it's a very tricky period to get involved or engaged in the markets. So this is kind of the second best option as well, I can use these as well. Think of them as an organic trend line, right? So they follow price follows them. And generally speaking, this can be a very, very, very good way to identify a location where I can join a trend. So the purpose of kind of what we're doing now tonight isn't just about, okay, Buffett's got some good stocks, for example, or anyone can pick a good stock, but also where do we get in? Where do we get out? And also to be able to look at something and go, yes, it's a big name, but it's not that great. And I've got a couple of those I want to talk about. So yes, the moving averages follow price. They have a really good relationship with them. And one of the things I'd like you to keep in mind is that if you think of the moving averages as kind of like a train station, generally speaking, we would only want to join a trend from within the moving averages, and absolutely not if the train or price has already left the station. That's when it's a problem. So we want to make sure that we don't have to do that. So we want to really, if price has already left the moving averages, then we are usually going to want to stay away from it. So, and we'll have a look at a few of the big ones like Facebook and a few of the others where you can see, especially on a weekly and monthly basis. And again, this is what Simon was saying is time, kind of the time approach for investing is a little bit longer. It is ideally what you want it to be is a bit of a fire and forget. You just kind of, you pick a few, and again, you could have 5 or 6, or you might have up to 20. You really don't want to have a lot. You don't want to have 50 or 60. I think that's a little bit too much to manage, but anywhere from 10 to 30, possibly that sweet spot is 15 to 20. And really then looking for timings with those. And the weekly and monthly charts are usually going to be the key to success there. And patience as well, understanding that the price bobbing up and down every day is really just part of the ebb and flow of the markets. What you really want is to be part of the flow of price regardless. So think of it as, when you're on the beach and you see the waves coming in, they are, you've got waves that come in and go out, but at the same time you have high tide or low tide. So there's a kind of there's a shift. And so that's what we want to dismiss the general ebb and flow of the cycles. And obviously they happen less and less as we go on they happen less and less on on the higher time frames. So this is pretty cool, but I like the idea. This is a really great right off the bat, will give us a good indication of where true value lies. So we could go look at a few stocks now. We'll also have a look at, say, the S&P, and we can see how far it's deviated away from the moving averages. And that's generally a clue that we shouldn't get involved. And that's a patience thing. Because we can hear about people in the news, the people who bought in here, we hear about lots of people making money, and that's why we want to get in, and so we suffer from FOMO. And again, that's not a rational decision. We are very much influenced by our lizard brain, and it has this crowd following kind of instinct is hardwired into us. So the more we feel we're missing out, the more we want to get in, and the longer we hesitate, eventually we jump on right at the end, and this is what happens. And all of that has come from irrational needs or wants. Okay, so generally speaking, we talk about price action swings. Okay, so swings meaning these are the turning points. Okay, so this is a swing low at the bottom, and these are swing highs at the top. So we can see it because we'll see that there'll be a candle in the middle, and price will actually break the low of it. And so that subsequently becomes a swing high at that point. And again, at the bottom here, we can see that kind of price came down here, and then we had a little bit of a bullish candle here, and then we broke the high. So we got that turning point. And so as a trend-based trader, I'm really only interested in getting in on the swing lows. I'm not trading it back. I'm not trading a counter trend. In fact, I don't know a lot of people who make consistent returns who counter trend or counter kind of trade against the trend. So that's some caution there. And then, of course, this in addition to individual candles. So if you imagine that this is a sentence you're reading, the individual candles can almost be like an exclamation point, or they can be, they can be an emphasis on a particular thing. So we can get signals from that. So this is a sentence kind of made up of words, and each candle is a potential word, so to speak. So the next thing we talk about portfolio diversification. Ray Dalio is a phenomenal investor as well. And if you go onto YouTube and you Google Ray Dalio Holy Grail, he goes through this immense kind of explanation for why diversification is a good idea. Because the whole point is that if we diversify with the idea that each individual I want to say, what's the word I'm looking for here? A constituent, okay, which could be anything. It could be a stock, it could be anything. The idea is each one should in itself should have growth over any given year. So in other words, our selection process is not to pick something that grows and then that has a really good kind of performance, and then throw something else in that doesn't for the sake of hedging, which is a funny thing that people do. They'll kind of buy gold and then do this and do that, and then in their mind they've hedged against all kind of scenario, and there should be a little bit more to it than that. Ideally, we want every single constituent that we put into our portfolio to have already been chosen, because the probabilities of it having some kind of return is high. And therefore, what happens is, if out of that portfolio 1 or 2 have a bit of a blip, that blip is reduced largely by all the other constituents who are performing well. And so this is why he says that actually what you do is you do increase your returns, but the bigger benefit out of diversification is that you reduce your losses, or you reduce your risk. There was something else that I wanted to add to that. Okay, we'll get to some. So Warren Buffett believes that if you do know what you're doing, then it's not really diversification. He's selected everything intentionally, as opposed to kind of diversifying because he's, because a person is confused or worried that, they don't trust their own decision-making processes. So I want you to have a look at that after this. Go have a look at that on YouTube. And then also, although some correlation is allowed, so right now we have what's called the rising tide lifts all boats. We have, generally speaking, most of the stocks are climbing, and people are kind of going, well, why is money flowing into all these other areas? There's a lot of countries that are doing stimulus packages, and there's a lot of wealthy people who have surplus cash, and so they've kind of like, well, I've got enough Apple stock. Where else can I put my money? And so that's why you're seeing everything's kind of topping out, and they're looking to move their money into other areas. Okay, so there will be some correlation. Like right now, we generally are in a bull market, and one of the things that I love about why I always recommend that people should look at stocks as opposed to, you get into trading and you start with Forex. Forex is great. It has its own reasons like why we would do it, but stocks, especially in the US, have a long-term history of going up. So what I mean by that is the probabilities are that the market's going to go up, and there's kind of a lot of misinformation out there. There's an urban myth that that the markets go sideways for more than they trend, which is false when you actually look at stocks. Excuse me, stocks will actually trend way more than they go sideways. Whereas with currencies, they could potentially consolidate quite a bit or change trends. That could be shorter term. And there's a reason for that. Okay, so you must understand that kind of the world is a little bit upside down at the moment, where what used to happen was the interest rates, the central bank in each country would sort of control the interest rate in order to curb like spending. So if the markets were getting a little bit crazy, they would kind of increase, then they would kind of up the interest rates, or they would kind of, and to manage to kind of curb the enthusiasm. And kind of since 2007, 2009, the global financial crisis, they kind of got to that too late. So the problem is they kept dropping all the interest rates because they were getting nice growth because people are borrowing money and people are spending it. And so that's kind of, in order to kind of stimulate an economy, you drop the interest rates to do that. The problem is then after the global financial crisis, everyone was stretched so thin and they had dropped the interest rate so low, there was kind of nowhere else that they could go. So that's why they've opted for QE. So now they're kind of doing that sort of approach. And so we're kind of in the same scenario now. So they were trying to up the interest rates between 2009 and now, but they didn't get them really that high. They go up to 2.5 or something, as opposed to like 4.5. And the reason I bring this up is that that's part of what has fundamentally changed the currency markets. The biggest long-term mover in the currency markets was the interest rate differentials between different central banks, Japan versus Australia. So they'd be like borrow at 1% and lend at 6%, and then it was called a carry trade. And then this created these beautiful long-term currency trends, which is really nice, which you don't get anymore. Not really, not the same way, because the interest rates are all very low, and it's not really worthwhile. So that's just if you wanted an explanation about that as to why kind of Forex is lower down on the list. So another thing is that this is known as a golden butterfly portfolio. This is really what you would split your portfolio between a bit of gold and some short-term bonds, small cap value, long-term bonds, total stock market, and you would sort of weight it 20% across the board. And so that, as a broad approach, again, each thing should be specifically chosen because you like the look of it. And then the idea is that collectively now what's happened is you have got some diversification. Okay. Gold, gold, we'll have a look at gold because it's on the platform in the background. But gold, there was a point in 2011 where everybody thought silver and gold was going to run away. It was never going to come back. Just like 3 months ago, everybody thought Bitcoin was never going to come back down. And it always does. It always does. Because there's just a point to which there's no more buyers. There's just no more buyers. And eventually then people who have bought want to get out because now they're like, okay, it's not going anymore. And then it creates this tipping point and it starts coming back down. So it always happens. And yeah, so as I said, look, some correlation is allowed. The goal is to expose ourselves to a variety of markets as much as we can. And this is all stuff that Simon was saying in terms of a bit of pharmaceuticals or technology or different things. Remember that today, so one of the biggest differences between us now and 100 years ago, so 1896 was the Dow Jones Industrial Index was created. Was back then everything was rail or shipping. I mean, it was metal and steel. That was our industrial stage of our society. And today we're technology, which is why the Nasdaq is a good indication of that. But we should actually kind of combine them. We should look at the S&P, the Nasdaq, and the Dow together, maybe with the Russell 2000, to get a sense of the global economy, because the US is, in that sense, it's the biggest GDP, and it does give us a good clue to that. So, okay, so then just to wrap up on this as well, Buffett's got kind of, generally speaking, he's got four rules, and the reason I'm a big fan is because he's about common sense. You can go verify this yourself independently. Go on to, again, on YouTube. him and Charlie Munger, his partner, they get asked questions at the annual stockholders meeting or shareholders meeting, and he states that he could teach you everything that he knows that you need to know in a week. So, you know, both him and Charlie Munger do not really feel that hedge funds are really worth, you know, are that great. He's actually there's a special website somewhere where he talks about how he's taken a bet that he can outperform all the hedge funds or something like that consistently. I've forgotten what it is. We'll have to Google it. But it's a very interesting little story. And the other thing that I wanted to add in here is, well, I'll come back to it. But so the point is, he's got a very much a common sense approach, right? So the first thing is he's always saying that the company itself must be managed by vigilant leaders. So leadership is a big factor in choosing a company, because he wants stability. He wants a company that has a few factors like there's a gap between them and their competitors. They've already entrenched in a market, and their managers, the management is very calm and stable and sensible, and so he can trust, because there was a point to which he was actually running a lot of the companies, Warren Buffett, and then he brought Charlie Munger on board, who then said, look, I can help you make this scalable. And that's when things really changed. But good management means the company should remain stable, right? And the stock should have long-term prospects, which is the moat that I spoke about, various other things. The business should be understandable, and it should be undervalued. And the undervalued part is actually the tricky thing, because how do you determine if something is undervalued? And so he uses two processes: intrinsic value and the quality of business, which is strong fundamentals. So in this case, strong fundamentals refers to good management, you know, costs, overheads, things like that, which are particular to that company, not necessarily its ecosystem or the ecosystem that it's a part of. And so intrinsic value is a tricky one, because intrinsic value, I'm just bringing this across. We're not going to go into this in a huge amount of detail. The reason is because the purpose of these kind of webinars is not really to go into this specific stuff, but mainly because this is a moving target. So for those of you who aren't familiar with it, if you want to work out what the value of the intrinsic value of a company is, you kind of also want to be able to have an idea of what their cash flow projections are for a certain number of years. And then you have to discount it, because over time, due to inflation, money 5 years from now is not worth as much as it is today. So let's just say that a company is going to make, you know, 100 million or 10 million projected cash flow each year for the next 5 years. The 100 million in 5 years' time is actually only worth about 69 million. So it's because of that, depending on the discount rate you use, the point is that the money loses value, and therefore he has to take that into account. So it's a whole complicated thing, and different people have different ways of calculating this, and all of them agree that it's tricky, and the more precise that you try to make it, the easier it is for the real life results to deviate from that. So it's very tricky, and so Buffett always tries to use very general rules and try to get it as close as he can. But you know, this is really the essentially, if we're trying to do it. So there's a different way of doing this, which is to look at what the charts are telling us. So it was very interesting. There's a quote, I was trying to find it, and it comes from Warren Buffett. Basically, he was saying that there are two things that influence a stock price, and it's very important that I think you remember this. There are two things that influence a company's stock price. One is the actual intrinsic value, which is you know, how much profit it's making, what are its overheads every month, and you can kind of see that happening. And the other is the public's perception of that share price. And so often what we are seeing when we look at the charts is the public is constantly trying to find that happy medium. So it overvalues it and then undervalues it, and this is where we see price kind of doing an extension and then a correction and then an extension and a correction. And so, but visually, it can give us a really good sense of where we feel the low end of it is. And our goal is to come in at the low end. So we can kind of cheat, because we won't necessarily be looking at it the same way Buffett does, but we can certainly determine when it comes back into what we would call an area of equilibrium, which is where buyers and sellers are kind of have reached a turning point. So then I also want to talk, before we go to the platform quickly, I want to just talk about there are obviously different time frames for your lifestyle. So this was listed in the webinar description, and I want to talk about this very quickly. So we've got a couple of choices here. We can be day traders, which you hear about, which is the same as intraday trading. We've got end of day or swing trading, and we've got momentum trading. Okay, so intraday is the one that consumes. It's stressful. It's requires vigilance. It can be quite tiring, and it requires screen time. So you have to be there sometimes just waiting, depending on the time frame. If you look at the 5 minutes or 15 minutes, you have to be there at that particular point in time. And so, and also because the markets are moving faster on the lower time frames, you might need more experience. More experience just means, you know, you've done your time, you've paid your dues on the higher time frames, and you can now move down the lower time frames. You've got a sense of context of what's happening on the lower time frames in relation to the higher time frames, and it's your ability to make accurate, calm decisions has improved because of you have experience. But in this case, most of the time, and this is why it's called day trading, they would, and this again goes back to the 60s and 70s and 80s and stock traders, they'd be trading, you know, the markets there, and then basically they didn't want to be exposed to potential gapping or any kind of a big shift in price overnight. They would close out all their positions and go home, and that was it for the day. So, but that's, you know, that can be a long time. You could sit there from 6 in the morning until 8 at night sometimes, and that's just kind of exhausting. That's not really ideal. So normally what happens is people who progress in that area will focus on just a session, 2 or 3 hours, maybe 2 sessions, and then they'll do all their trading during that period. End of day swing trading is really good. I'm a big fan of it. Basically, you go to the 4-hour daily time frame, much less screen time. So if I just look at the daily, basically it's really straightforward. If I have a series of charts that I'm looking at, I'm looking for an entry on the daily. It's either there or it isn't. It's a yes or no. It's very much a binary kind of setup. Depending, and this, by the way, is going back to, we'll cover strategies in later in parts 3 or 4. We'll go into an actual strategy for this. The point being is that it's much quicker to go through, and there either is a setup or there isn't, and it's crystal clear. And so because there either is or isn't, you can do it in 30 minutes, for example, maybe even 15 minutes. Like some nights there are going to be quite a few setups, and then you've got to place your orders. Or you've got to update, very important, you've got to update your stop loss from maybe open orders as well, and maybe you have to cancel orders that have been negated. And excuse me, and this is where Simon said as well, you want to be really paying attention to the stuff. You've got to be doing it, but you don't need to be thinking about it in between. What I mean by that is you've done your time in the evening when you placed your orders, for example, or just ahead, or just outside of, either just before or just after the market opens, and then you can just come back to 24 hours later. So you don't have to sit and obsess over it during the day, because the market will do a lot of things. I often see this, we call this kind of ebb and flow. Often see in the morning, when the US is still asleep, the market is kind of correcting, and then when the US comes online, it then starts to pick up again. So during the US session, it tends to just grow, but overnight, when it's not the US session, it tends to kind of correct. So the point being is that a lot of people in the morning in the UK, newer traders, are going, oh, well, I need to, the market's crashing, I need to become a seller. And then by later in the day, sort of 2 o'clock, 3 o'clock, 4 o'clock, the market just starts taking off, and they're on the wrong side of it. So we do want some awareness or context of that. Momentum is really, is in essence trading the daily, but looking for an entry on a lower time frame. So you're trying to bring your stop loss and your entry closer together so that you can kind of get perhaps a greater reward to risk ratio. And sometimes it is very viable. Sometimes you could take a trade that is that would maybe be a 3-to-1 on the daily, and you make it like a 5-to-1 because you get in on the 4-hour, for example. So it's worthwhile doing it, but you don't have to do it if you don't have time. It does mean that sometimes you have to, every 4 hours, you're going to have to just look at the chart. So it's somewhere in between where you might collectively do an hour a day, but that hour might have been spread throughout the rest of throughout the day. So it might have been like, every few hours you just check, okay, is there setup, isn't there? So, but it also gives you a slightly better quality of life. So generally speaking, and I know this from anecdotally, but also from personal experience, people who do the end of day stuff or the momentum stuff generally have better returns. The stuff that they don't obsess over tends to do very well. Okay, so and then lastly, before we sort of go to the platform, I want to talk about changes in trends. Okay, so this being an uptrend here, which is made up of high lows, high highs. This is not a very complex idea to understand what an uptrend looks like or what a downtrend looks like. And that's not the issue, but most people feel, newer traders can often feel that it's so obvious. How is it relevant? And actually, this is the point, is that we need to say that when we arrive on a chart, if it is currently producing a high lows and a high highs, then we should be buyers. If it's producing lower highs and lower lows, we should be sellers. And it's interesting because I often see a lot of stocks, and there's a company that, well, I see it often. They'll be talking about why a stock is a good buy. And then I'll be looking at it, and for the last 5 years, it's been going down in price. So they'll be like, well, fundamentally, it's a really good deal. My issue with this is that if fundamentally it was a really good deal, then why is the price not increasing? Why is the price not going up with it? So for me, to kind of buy into a stock that has a 5-year track record of going down doesn't make sense. I'd rather, if I am only allowed to have 15 constituents in my portfolio, I'd rather that each one of those was bullish or had a good trend. So the point is that in this case, we've got buyers that are pushing up, and then the buyers kind of take profit and the sellers come in, and then the buyers exist here and they can push price up to fresh highs. And then the same process repeats itself. So when the market actually comes down and breaks below this previous low over here, that means that the buyers that were here are not there anymore. And so now the market is actually actively investigating fresh lows. And so what it's telling you is that, yes, this trend is effectively done. And again, here we have this downtrend, and when price comes up and breaks this previous high, this is an oversimplification, but it is now saying, okay, the sellers that were here that could push it down, they don't exist here anymore. And therefore, it has changed. And so we should now either consider not selling, or we should potentially consider getting out. And so this is why we often talk about putting our stop loss behind. Okay, so behind a swing high, in this case, a swing high or a swing low. And then horizontal price levels. So this is gold. So this is gold. I was saying that it's I was going to talk about it. So this I want to just show you. Up in 2011, it was going insane, and then it kind of dropped down, and actually then it fell right down to 1350, and it was there for until 2019. So from 2011 back until 2019, it didn't go anywhere. And all the people that were saying, oh, gold is just going to go through the kind of would never come back down, you never really hear back from them after that. Okay, so on a much bigger, I want to draw here quickly, on a much higher time frame, what's really happening, if you could look at a year's, instead of a monthly chart, you could look at a yearly chart. This appears so far to be the case. So my expectation for now is that it'll go back to 2000 and then potentially go on from there. Excuse me. But I also wanted to show you something here as well, is that sometimes the prices can be very close to round numbers. So $1,600, $1,800, $1,900, $2,000. And so we can see that the market responds to that. And it makes sense because, fundamental analysts will have numbers. At some point, they'll have a price and go, okay, it's a good price at this price, or it's overvalued at this price, or, and so on and so forth. And so the beauty is that understanding that horizontal levels are really the foundation for what we see on the chart, and that is where fundamental analysts and technical analysts meet. Actually, what happens is, really, as a technical analyst, we're just watching where the fundamentals have kind of placing their active orders. That's what we're really doing. We're kind of watching the market from a distance, and then we're just making decisions on top of that. So one of the things that made the biggest impact, which shifted me into consistent profits and stopped the crazy, was, I was subscribed to Nick McDonald, who founded Trade with Precision. He was doing pure technical analysis, and every week he'd do this newsletter. And he would say, oh, we've got non-farm payroll out, or we've got, maybe there's a central bank announcement or whatever. But that was it. All his decisions were purely technical. And what would happen is, I'm still trying, at that time, I'm still reading, I've got my favorite blogs, and I've got all these different analysts that I followed, and the market would be consistently kind of unpredictable. And so my results were very inconsistent back then. And then after watching Nick for about a year, and there was a concern with trade wars, and there was a worry about the euro was going to crash. There was all kinds of stuff back then in the news, and there's always something in the news. Excuse me. I remember he was just saying, well, it's bullish, it's going to keep going, and he was just going off the technicals. And after about a year, he was always right in terms of what the market would do and how he'd approach it. And that convinced me to just stop listening to the news. And then I think I've never looked back. So ever since then, I've always found that I can talk about stuff that's in the news. Let's talk about Bitcoin. Let's talk about this kind of stuff. But applying that to my trading is not the way to go. So in other words, technical trading is for me has been the way to go. So I wanted to kind of talk to you about that. And just to remind you exactly what Simon was saying as well, is obviously we need to make sure that, you know, our goal when we're watching it is we're looking to buy on the dips. That's effectively when you think about that, if the market is bobbing around a central kind of axis there, it's overvaluing it and then undervaluing it and overvaluing it and undervaluing it. And although it seems counterintuitive, we really want to be looking for those areas in the moving averages where we can buy in the dips, and that's what we want to do. And once we've done it for a while, your confidence will get there because it'll start to make sense to you. So these are some of the charts. I'll go to the platform in a moment. I wanted to show you this. We'll see where, excuse me, it'll be very interesting to see where they've gone since last month. But again, what I want you to take note of here is to see just kind of that overall the performance of this has continued to climb. So I've got a couple of indicators here. I've got the MACD and I've got the RSI. And the way we use them in the city, which makes the most sense to me, is really if I'm looking at getting into the market. So let's just say, for example, I want to get in at this point here. So if I could go back in time, and that's where I want to get in because the price has now come back into the moving averages. But I want to make sure that I've got as many green lights as possible. Usually at that point, so you'll notice that we kind of got a fresh high in price here. So it goes from that high to that high. And usually at that point, what I'm looking for is to make sure that the MACD is going higher as well as is the RSI, just for that period of time. So that what that tells me is if this is trending higher, then the momentum is good. Because basically what these indicators do is they measure the speed of the market. So it's speed over time. And so like now, if I look at this now, we kind of got price going up there. We've got the MACD trending higher. We've got RSI trending higher. Okay, so basically it's trending higher, which means that the momentum is good. When we have a problem is when you get to an area like this where you're getting a fresh highs in price, but the indicators actually started to trend lower. So we call this divergence. So we use two indicators as a double confirmation. So we don't get false signals. So if both of them are in agreement, if both of these are diverging, then it just means the market is not moving as fast now as it was, so it might be exhausted. And therefore there could be a change coming. So Walmart as well, again, looking for this general increase in price. It is a very messy chart. I would go look at the weekly and monthly. We could do that as well to see where these kind of areas. But for me, these areas are going to be the ones of interest. Will be looking at it will be the ones of interest as to where I'd be looking if I want to buy that particular stock, especially when it also overlaps with a support or resistance level. That's even better. So what we're actually doing is we're building up a case. Because all the fundamental analysts will have their price orders sitting at these things. And so the market will come down and bounce and turn around. Okay. And so especially when it matches up with horizontal levels and the moving averages, then it becomes a sweet spot where I could look to get into it. And also having that approach, that time approach that Simon was saying, that you hold it for a longer period of time. So we could be saying 6 months to 2 years on the shorter end. So you could go for longer, 5 years, 10 years or more. But time in the markets really gives, and then not getting emotionally invested, is a huge thing. Learn to, it's like a watch pot never boils. That's the expression. So we don't want to be doing that. Okay, so here's an example of something where inherently this is not, for me, not a great one. And Exxon, BP, Chevron, there's a whole lot of them. They all actually have very similar, they're very correlated to this. And actually most of them have been underperforming since 1998. So if you can imagine 20, 21, 22 years of consistently losing value. Okay, and it's a big name. So also what Simon was saying, if it starts to underperform, you've got to have those rules to say, listen, get rid of it temporarily and come back to it later. But there's always that fear of, oh well, it came back and it bounced back. But generally speaking, especially when we look at it on a monthly basis, if it is just hitting lower on a monthly basis, that's not a great place, because I mean that shouldn't be happening. I understand why it might go up or down for a few months, but if it's going up or down, if it's just going down for a few years, then the company is not, in my opinion, is not fundamentally strong. And so here's another one as well. This is Chevron. So Chevron has gone almost nowhere for 20 years, going largely sideways, stuck between kind of highs up here and lows down there. So if that's the plan, if you're wanting to have dividends, you're looking for that kind of a setup, then there's a and also if it goes up in value, then you might say, well, that's a bonus. But if you're starting from the perspective that you want a relatively consistent increase in value, then this is not really ideal for me. If I'm limited to 10 constituents in my portfolio, I'm just not sure why I would do this, even for diversification. I'd maybe rather just sit it out. So okay, so let's go across to the platform. Let's bring this up and let's do this. Okay. So a couple of little things. So I've set mine up because largely, sorry, I'm just trying to move this around. I've set mine up largely to keep it relatively simple. There's multiple panels on the side. There's a tweet center. If you do want that information, the stock scanner as well is a great feature. It really is a fantastic feature, because what that can do is create a shortlist that I can then look at, and then I can go, okay, well, if it's going down over the last 10 years, then I'm going to pass on it. But generally, if it's trading high, I'm going to go with that. And so, yeah, there's a lot more detail on this one. I've gone in to set mine up essentially what I'm looking for as well. And I've also got some preferences in terms of color up here. But what I've gone is to set up with my list on the left-hand side, and then I can study the chart. So I want to really do that. And then I've added in the MACD and the RSI. So let me just talk about that for a second. Okay, I don't want to obsess about it. We talk about the swing lows and the swing highs. Okay, it is trending higher essentially. Okay, this is a bit of a messy patch here, but broke through here. It's actually come back to test it, so that's fine. I like the look of that one. So we're going to do this again. And yeah, so that's a really nice level that it's come through the test, and it looks very much as though it's not carrying on. Come back into the moving averages as well. And again, what we can see here, if we just kind of stay focused on this right now, so we can kind of see that it's trending higher. Okay, it's matching what price is doing. We can see price comes down here, is going up. We can see this is going down and going up. It's coming down and going, sorry, it's coming down and going up. So it's matching what price is doing, which means that the market is moving at a consistent pace. It's when it doesn't match what the market is doing that we have a bit of an issue, a bit of a query, as they say. Okay, so let's go through a few of these other ones as well. I have a list of, let me just do this. I want to go through some of these as well and have a look at these. Okay, so let's have a look at, we could go through and have a look at some of these, some of the stocks as well. We've got the Dow Jones here. So let's go through a few of these. Let's start with Apple. Okay, so we're looking at this obviously over a monthly chart, and you can see that essentially it's gone what we call parabolic. So the problem is that also you can see that over time it comes back to connect with that 50 moving average. Okay, so it is kind of every now and again, it hasn't touched that 50 moving average in a while. So what's potentially going to happen here is that this will move up, and at some point price will have a correction, and then you'll get that kind of, then it will recover from that. But this has gone parabolic, and this is always a little bit of a fear when we get to stuff where the markets have gone that way, because when they go parabolic, they tend to have a correction, so kind of that matches that. So if you had to draw a line sort of here that goes kind of more in this kind of direction, then this is probably where kind of this would be a really good place. But psychologically, if we saw Apple drop down to 80 or 70 in that area, it would be really hard for people who are untrained to go, that's a good deal, I should get in. They'll be panicking. They'll be the other way around. They'll be going, oh my God, it's dropping, it's dropping. It's can't be a good time to buy. But actually that's a really good time, because generally speaking, they'll usually recover from that. So you just have to understand why it's so popular. So let's have a look at a few of the others. Let's look at American Express. Okay, so again, this is a great example of now is not a good time to get in, because again, It's not in the moving averages. It's very much overextended. True value is probably sitting closer to somewhere around 130, maybe another area down towards 100. Let's call it 100. Okay. So those are kind of the areas where I'd be looking to do it. Certainly, I would say anywhere 130, 120, but this is not a good time. Okay, so it depends. My brother was a big fan of Tesla. And this is anecdotal, exactly. This is the guy had been talking about Tesla for years and then eventually got off his ass and bought Tesla stock. And he did well. I mean, he got in at the right time. But he should have got in when he was raving about it. So the idea is that, yes, if you would use the product, if you love it, if it makes sense, then that's maybe one reason to get involved. As opposed to kind of, if we look at something like Barclays, and I have a Barclays bank account, but Barclays stock or Tesco stock, they're not necessarily that great. So I want something that has generally an uptrend. And let's have a look at something like Boeing. So let's see what Boeing looks like. Let me have a look at the questions and comments as we go. Let's have a look. Anything in the chat? Any questions? Let's have a look.
I don't know your question.
Yeah.
There's a lot of people that you're talking about, people that your brother are getting into Tesla, and they know the products and they know the stock. Is it worth, do you think, really getting to know fewer bigger stocks? Is that a good way to go?
No, I think that Buffett's approach is that if he understands it and he likes the product, he always thinks that that's a safe approach. And actually, there are a few people saying that if you would buy their products, then that's often a good. I would think of it as a bonus. But for example, there might be stocks that I would buy into that we don't have in the UK. It might be a US thing, and so my decision wouldn't be based off that, Jeff.
Well, that's what technical analysis allows you to do, doesn't it?
Yeah,
really,
yeah.
To even disregard completely what the company does, and go off that. So, but I mean, there's two forms of thought there. Yeah, there's getting to know the company, but it's maybe not the best thing to do because maybe it tracks back to that idea of getting emotionally attached.
Yeah.
You know,
Yeah, exactly. It can lead to that. You find yourself getting involved. Yes.
Yeah, that's true.
True. So yeah, and then just keeping an eye on the time. It's 6:10. We're doing all right. So let's go through. So Boeing, of course, again, who would have thought, 2-3 years ago that this is kind of what was going to happen? But actually, it's not a surprise because they've been talking about it since avian flu and a whole lot of things. There's in our future, by the way, because we have so many people on the planet, the threat of a virus mutating and spreading is a factor now that wasn't a factor 50 years ago. And to kind of give you a sense of that, if I'm showing my age here, but if we got rid of every second person on the planet now, we'd still probably have more people than were around when I was born. So the population has more than doubled since I was born. So that just gives you a sense of we're quite tightly cramped. Anyway, point being, it is a continual thing of viruses mutating, and this will probably, next to climate change, will be the biggest threat that we have to face. So this might not be the only time in our life where we have to do this. So let's have a look at Caterpillar as well. Just want to run through these ones here again. I prefer it when it's sitting down towards the moving averages or down at a key level. And again, you can see some of these price levels look pretty good. There's a couple here. And that area, so this area is a really nice one. If in particular, I would start on the monthly as well, for example. And so I'm going to show you the monthly and the weekly. But what's important is that if you look historically, you can see how far away the market goes before it eventually does have a bit of a correction. And I would say that I've seen some of the biggest moves in history now, where we've moved. We've either gone parabolic or we've gone a very long way away from market value. Market value is roughly, as a guide, is roughly somewhere between here and here. Okay, so it's usually between the 10 and the 20 moving averages, somewhere there, which means that if it's really strong, it'll be a shallower correction. If it's not as strong, it'll have a deeper correction. But that is a really good area. So if you're wondering what the true value of something is, usually it's going to be somewhere between in those two areas. So Caterpillar again, but let's have a look at that on a weekly basis. So if I go to the weekly chart, here, the cycles look really good. Shame, my dog is boiling. The cycles look really, really good. And so if I wanted to take a shorter term approach, so you're saying to me, Adam, this is great, but I can't, you know, like the time cycles, I could have to wait a year to get in. The weekly then becomes a really nice viable option. So again, in the next session, we'll talk a bit more about actual strategies and entry points. But these little bullish candles in an uptrend, these little bullish candles become very appealing to me. So there's a couple here that become entry opportunities. So this is a nice one. This is a really good one here. This is also a good one. It's not bad. This is a good one here. Now we're starting to stall a little. If you see here, we've gone to a fresh high in price, but you can see that MACD is starting to go a little bit flat. RSI is starting to go down a little bit when price is going up. And so it's becoming exhausted. And you can see also there's more red candles here than in these areas. So basically there's just more sellers entering the market now, or taking profit, whichever way you want to put it. But the weekly chart can become very powerful in that respect. Let's have a look at Cisco Systems. Okay, so Cisco Systems climbing up here, also got some really nice entry opportunities here, not as nice as Salesforce. And again, you don't have to like the company or anything, but this is about making money. And so my logic is that if you can make money off a company you don't like, then all the better for you. Let's have a look at Disney. Okay, so we've got a monthly and we can have a look at whatever the maximum period of time is. And again, and Buffett is also saying, look, his biggest issue is he's got so much money that he can't necessarily get involved the way that he used to, because his position sizes, his stake will be so big it'll move the market. But for individuals like us, we do still have that opportunity. But I think the key thing here, and you can see this market has become overextended, wants to come down a little bit. The key thing for us is just remembering that we need to, that when we talk about timing, that timing should always be from, generally, I'll go into more detail next week, but generally it should be from the moving averages. Ideally, if it overlaps with a key level that we can spot, and learning to identify those levels, if they're near round numbers as well, that just takes practice. You pick up an eye for it, like I suppose you would have an ear for music. You just do eventually develop that. And again, you can see this level here sits sort of in between the 10 and 20 moving averages. So it's a good one. And if you use Fibonacci retracements as well, which pivots Fibonacci are very reliable. If you use, they're more reliable when used in conjunction with other things, support, resistance, or round numbers, for example. And so here, this highlights this area. It's probably a 50% fib level from this low to this low, and it's probably a 382 from there. So then that's what we call a cluster. Then it overlaps. So let's have a look at the others. Let's go here, see how this is doing. Okay, again, trending a little bit higher. This is on the monthly. If I go to the weekly, it looks really good. So this becomes very rhythmical. And all we're trying to do, so all we would actually do if we wanted to be somewhere between a trader and a long-term investor, we wanted to hold a position maybe for 2-3 months at a time, is excuse me, is look for these entries. And then for example, this is again oversimplification as to what I'll cover in the next session, where we go a bit more into detail. But again, I might put, buy at this level if price breaks the high, put my stop loss below the low if I want to employ that. And again, the good news with that is that if I do have, if I do find that the position is secure and there's another entry that I can get in on, then I can effectively scale in if I wanted to do that. Generally, I'm going to want smaller candles. The smaller the candle, the sooner I can get the more I can get my 1 or 2 or 3% in. And again, there's nothing stopping me from seeing this and then getting a little bit of an entry in on the daily. So I get in with a tighter stop loss, or I get a better risk to reward ratio. But the decision to get in is based off the bigger picture. Let's see, Goldman Sachs. Okay, good. Yeah, not bad. Again, you can see that really nice cyclicity, if you want to call it that, so that repetitive behavior. Home Depot as a couple of examples here as well. And again, I want you to just see that, a lot of these are generally climbing. What I found interesting was how some of them have very calmly recovered from I'm going to go through the search window again, advanced search. The platform and my lap and my machine have been disagreeing a little bit. So you might find for whatever reason that if it crashes on me, I'll do this. Just have a look. Come on. I was looking for Costco. There we go. Okay, just going to wait for that one to come in. Come on. Oh, there we go. Okay. But look at that steady growth. Just the point being here is that look at that. And again, this should be the primary criteria for whether something should be considered or not. Okay, if it's not generally got a steady kind of climb or kind of trend to it, then I don't think it should qualify. Okay, there's definitely something else while we're at it. There is without a doubt something else happening here. We can see the reaction against price, and it's kind of struggling a little bit, and almost looks like it's a little bit of a little bit divergent there. So that could be a bit of a concern. Okay, what we can do while we're doing this, by the way, is we can start answering questions. So if you do have questions, please throw them in. And Simon or Antonio, if you want to come in and have a look at a few or chirp in, then please do. Again, here's another one, like for example, 3M. This one is, for a couple of years has obviously not been doing well. It's managed to do well. And the question is, are these doing well now because there's surplus cash? So there's just cash in the markets, and therefore very wealthy investors are, boosting stocks that would otherwise not get attention? Or is it, stimulus or bailouts, or what is it? But I would have said that it would appear that it hasn't had this kind of growth in a while. So, and maybe it's as a result of cutting costs, people working from home wherever they can. There could be a whole lot of different reasons. Like this for me would not really qualify. Okay, that's not really ideal. Microsoft is a winner, so Microsoft, you can't go wrong. In terms of, sorry, again, these are not financial advice. These are just things that I like the look of. Visa and American Express make sense because, and with Microsoft, they get huge kind of little, every time you're using your card anywhere, they're just getting that kind of cash flow coming through. And when you get like Microsoft have massive subscriptions now, they're just like, so the money is almost, to a degree, is almost predetermined. Walgreens, Walmart. Let's compare Walmart to Costco as an example. Again, it's also got that pretty steady kind of growth. Simon or Antonio, do you have any other questions so far?
Well, can I ask a question to the audience, actually? I just noticed a question from Ken in the chat box there saying he's looking forward to your entry points webinar.
Yeah.
Which I think we'll cover more next. Well, it's actually this month, 23rd of June. So it's 2 weeks away. Can I ask everybody if you can take to the chat box just to let us know what is your objective from investing? Is it trading off the charts? Do you think that this is the thing that you would like to do, sort of shorter to medium term trading, looking for entry? I mean, not necessarily day trading, but short term swing trades, or is it building a nest egg, building a portfolio? Because that's a sort of thrust of what we've been talking about today, is putting the building blocks in place for having a portfolio. But you can do both. But just to give us that feedback would be really grateful. And there's Ken saying trading purely off the charts. Swing trader, says Akira. That's great. Just to give us, because I think just judging from the comments, we've got quite a few traders here as well. So I hope we're swing trading, says Date, Tati, I pronounce properly. That's good. So we're catering for both here. We do have traders in the room. Thank you for that.
Great. Yes, I was going to say as well, price levels where price is connected from both above and below are way more significant generally. Obviously, if we're then starting to get into uncharted territories, then we start to, or all-time highs, then we have to start looking at, say, round numbers, for example, or maybe Fibonacci extensions. But yes, just wanted to talk about these ones here quickly as well. So let's have a look at Coca-Cola on this side. Yeah, quite interesting to see how some of them have coped. So the reason I brought up Costco originally was to demonstrate how easily or how well it survived the market kind of dip that occurred last year. It was just to bring that up again. All right, we'll see. There we go. So where was the correction? It was somewhere. Yeah, it was like here. That was it. That was the blip. So Boeing fell off a cliff, but obviously, for example, because that's travel related and so on and so forth, and also the margins on those business models are very tight. But yeah, that was the blip that impacted Costco. It did almost nothing, because in situations like that, this is what I find why it's a clever idea. As a company like Costco, there's little things. This is not rocket science in terms of hi Stephen. In terms of common sense stuff. If Costco, it's an amazing place because you can buy everything at massive discounts. And actually what happens is people, families that maybe aren't earning that much, that's where they'll go because they can support themselves doing that. But then if you do get a crunch, like an economic crunch, people in the upper band who normally wouldn't go to Costco, who can afford more, they'll drop down. So usually in those economic crunches, Costco actually almost gets a boom because during that period, they gain more customers who suddenly are on a budget now. So just interesting. There are some that are almost arguably are sort of recession proof. There's certain businesses that do really well during recessions. It's also worth a Google on that one. Glencore. Yep. Antonio, how are you doing there?
Yes, I have seen a question on the Fibonacci. I'm not sure if you've seen it, Adam.
This is from Stephen Hill. Let me just have a look. Sorry, there we go. Bring up the questions. I've got two screens here, so I've just moved everything across from that. There we go. Sorry. Here we go. That's why. Okay. Here are all the questions. Okay, so just there's some questions for you. Hi, thanks for this so far. I'd like to know a little bit more about when the averages cross. Okay, and do these basic concepts apply to a range of charts? So let me answer that question because we're on that one as well. So the question that's being asked is using moving averages as a crossover, as a kind of a clue. It's not necessarily a bad idea, but I think it's better on a longer term one. So if I could just go back to have a look at some of these charts, and let's just start with say Apple. Okay, so I would also kind of be very keen on looking at price in relation to the moving averages. So not just the moving averages crossing over. Excuse me, but is price above or below the moving averages? Because that's almost more significant. It's kind of like here, you could see that Apple on a monthly chart, for example, has almost never really kind of dipped that much further below the 20 moving average, maybe down to maybe down towards the 50. And so if it did, then that in itself would kind of, it would be allowed in this case to go, I think, as far as kind of down towards 100 here and dip below the blue, which would still be, to me, in line with previous behavior, which would still be a relatively good buying position. And so at that point, I'm talking about price crossing over moving averages, because that can also be worthwhile. When we talk about the, let's say, for example, the 200 or the 50 moving average, and then they cross over, then that's where it gets a little bit more tricky, because actually it's probably better for us to then look at price. So what I mean by that is, right, at this point in the past, we had an uptrend because we had high lows, high highs. What we currently have is no clear trend. The price is consolidating, and it's on top of the moving averages, which basically means it's just treading water. So this is not really a good time to get involved. What I'm looking for ideally is when it starts to trend, and then I'm going to look for any of those pullbacks on that. And so, in other words, I'm only getting involved if the market is actually trending. I'm not going to just sit here and wait for it for 6 months to do something. So to come back to the question, a crossover of the moving averages, ideally I want to be looking at price first. Like I want to look at the high highs and high lows first and make my decision. And then the crossover, because the crossing over of the moving averages can often happen later. So at this point, we actually produced a high, then a low, then a lower high, then a lower low. We broke through that barrier here. The moving averages really kind of only crossed over here, which was maybe a couple of months later or a couple of weeks later. So the first thing I really want to pay attention to are the lows and highs of price and breaking of key levels. If there's a key level broken, I want to be looking at that first. And then I can also look at the moving averages as an additional thing. It's quite nice as just to have to look back and go, okay, the 200 and the 50 have crossed over now. All prices hasn't been below the 50 and now it's below the 50. So yes, there is some value in it, but I would encourage you to also look at price action. Let's have a look. Just going through all these questions. So the question here as well being, when you do investments, do you look at the PE or PB values as well? Often in books, they're labeled as core indicators. They can. I think my concern is just that if the chart is going sideways, or you take something like BP, or if their numbers look good on the books, but the stock price isn't going anywhere, then the numbers just look good on the books. That's my problem. So I don't have an issue with those ideas in principle. I'm saying I want those overlaid with a chart that has a really good performance. Because think about it like this. If I gave you every day, if I gave you a rundown of a company, its assets and liabilities, and like a statement, financial statement every day, and you can see how much money a kind of man on average, and then you could see, okay, well, pretty much every week we make this much, and that therefore is a trend. And all we're really doing here is saying, okay, if that trend had to continue, then would you, then to some degree it's predictable if it's going to continue. We can't guarantee. The future's not guaranteed. All we can really do is look at something that has a good trend, and then give it a fair chance to show us that that trend will continue. So, looking other questions. Trading of charts, split portfolio. Yeah. So the weekly chart could be a really good opportunity. A weekly chart where you could get in for anywhere from a month to 3 months, and then you're kind of technically investing. And your returns on that would potentially be really good, because you might do per position, you might, if it hits its 2-to-1s or 3-to-1s, you could be kind of up 8 or 12% across the board. And if they were going really well and you wanted to just hold, you could do that as well. So you could shift into that. But the key thing I want you to take away from this is there's a point when you don't want to get involved, when it's very far away from the moving averages. And then generally speaking, the fair value is generally where the moving averages are. So if we could start with that philosophy, then you should be, and then you know that you're looking for something that's trending up, you should be on the right side of the selection process. Yes, Simon?
Yeah, I wanted, I've seen a couple of questions, Adam. How do you screen stocks for swing trading?
Okay, so for me, I will generally work my way through the list and eliminate the stocks on the monthly or weekly that aren't trending. So what I mean by that is if they're largely going sideways, I will bin them. And they don't change that often. So you only have to do it every few weeks or every few months. And once I have found a list of stuff that is trending really well, then that will go to the top of my watch list. And then it's about patience. Then it's about waiting for that entry from the moving averages, which could be 3-4 weeks before it happens. It's not forever, but yeah. So
yeah, I've seen a couple of questions of wanting you to go a little bit more specific on your entry points,
yeah,
which was quite clear, in fact. So I've seen one before. I think it was a gentleman called Manuel or something like that, and I've seen another one which is more on a shorter time frame, but as your philosophy is pretty much the same regardless of the time frame. If you can just go back one more time to what is your system to identify an entry point.
All right, thanks. So I would wanted to go into the system in more detail in the next session, but to give you, so now that's because we need time on it. So I want to give you the entire list of things that I want to do. But in principle, I'm looking for a nice steady trend to the upside or to the downside. I will use the 10 and 20 moving averages. This is the 10 and this is the 20, and this area is like that train station. This is where I'm looking to join a trend. That's what I want to do. Then specifically, I'm usually going to be looking in an uptrend. I'll be looking for a nice little green candle, ideally a smaller one. So something of about this size rather than something like this. And the reason for that is that if for example, I'm going to get in on the break of the high of that with my stop loss below the low, for example, then, and that's 1%. If I decide, for example, to risk 1% of my capital on that, then it has a long way to go before I kind of make that 1%. So that's a bit of an issue. Whereas what I want ideally is to have something, this is not bad. This is pretty good. I could put my stop there as well. If I want to put it underneath a key kind of support resistance level as well, that's a bonus because it's just that added layer of protection. And then in this case, if, for example, I put my stop loss there, my entry there, then I go this far, hit my one-to-one compared to that. So I don't really want to get in on a really big candle. Ideally, I want to get in, with a smaller candle if I could do that. And this, again, this is on the weekly as well. You can see if you go back, if I go back and have a look at, say, 10 years, you can see that actually it's provided quite a few opportunities to do that in the past. And that's what I'm looking for. So that's cyclical behavior. The concept is that cyclical behavior should continue. So look at it here as well. One more thing I just want to show. We've got a high there. We seem to be climbing here. We seem to be climbing there. Let me go in and just put some levels in as well. Yeah, that's definitely higher. And that's fine. It has to be diverging for me to be a bit nervous, but it's not at this point. So that all looks good. So the other questions are building up. Yeah, okay, I'm looking at the other chat questions.
We've got great questions. Thanks everyone for asking these questions. And yeah, Adam, if you're okay for another few minutes just to go through one or two of these. I was looking at the chat. There's two places to put questions in. There's a chat and the Q&A.
And a Q&A, so we have to look at both. The question is saying, when would you execute a trade on the 15-minute chart, for example, and what would be the thesis behind that execution? Okay, so let's see if we can kind of go ahead and do that. So let's just say that I see last week's bullish candle has finished, or it's bullish, and that is a potential signal for me to get in. So this is principally the idea is that I want to get in on a break above the high of that candle. That's going to be my entry point. But ideally, I don't want my stop loss to be there. I would prefer if I can to find a tighter stop loss. So I'm going to go look now and see if I can do that. So if I go down to the daily, then there might be a potential tighter stop loss on that. Okay. And so there's nothing that's really standing out here at this point. I'm going to go down to 4 hours. Okay, so here we go. We've got a similar approach. For example, price is broken above that high, has pulled back into the moving averages, and you can see that level of support resistance. So let's just see if I can increase this 20 days. So this level of resistance is now potentially support, and so price is now heading off from this point onwards. So one way, for example, might have been to get in on the break above the high of this candle with my stop loss just here. So it's a much tighter entry, but it fulfills the criteria of the weekly candle, the high being broken. Therefore, the weekly is now starting to take off, but I've managed to get a tighter entry on the 4 hours. So let's go see if there's I mean, that's not the best example, but it was literally the chart in front of me. So let's go down to the 60 minutes. And so the idea would be the same sort of thing. I think in this case, let's just go down and see, we'll go down to the 15 minutes and just see what's happening there. So even here, I mean, this is a little bit on the crazy side, but the idea being possibly that here we've got this trend happening above our key levels. That's really the key thing. That's got to be where I've got to get in. And so again, I might look for a tighter entry. Here's actually a flat level, but yeah, even where we are now, for example, this little candle here where I could just be below that. So again, I mean, that's very tight because there's got to be. I might look. There has to be a reason why the volatility on the lower time frames could mean that I get triggered in and stopped out. Price could come back down to this level, then carry on. But generally speaking, yes, the trigger is going to be when price breaks the high of the previous candle, because that means the market is now following through. Okay.
Fantastic.
Okay, now I am just because I'm watching the time, I'm going to post a link to this. So there's definitely people here that are not customers, which is great, and we hope you are learning new stuff on the webinars. Everything that you're seeing, there's been a few questions about the PowerDesk and can I download it or is it on the browser, all these sort of things. Everything you see Adam using tonight is all included in your free account. So there's nothing you need to do. And further to that, there is an offer for everybody on the webinar who opens an account through the webinar to provide you with 3 months trial of trading stocks free of charge. So either 100 trades, which is quite a lot, or over the period of time of 3 months, you can trade stocks. You won't pay any commission for them at all. So all you need to do is to open the account using the link that I'm posting into the chat box at the moment. So hopefully you should receive that.
I wanted to add, sorry, I wanted to add a couple of things to that. Yes, costs are definitely something we want to keep to a minimum when we're doing this. That's obviously very important. And the other thing, just kind of was in my head and then it's kind of gone. It was the costs. Oh, it was kind of outperforming the markets. So generally speaking, if you look 10, 20 or 30 years, you look at the S&P, you get somewhere between 7 and 14% kind of on average return over that period of time. And so really our goal, if we can, is to kind of get into the 20%, which is feasible if we take the approach that we do here. It should be feasible. And if we're doing that, what should happen is we should be beating inflation as well. So in other words, our net gain should be comfortable. That's all I wanted to add.
No, absolutely. Now, someone was asking about crypto trading. Antonio,
I've answered that.
Oh, you
have?
have?
Yeah.
Oh,
I mean, I
you.
can add something on this for the benefit of everyone's listening. So we don't have any crypto offer at the moment, although there are a few ETF you can find in the platform just by typing blockchain or Bitcoin. So if you type in the search box on top of the platform, Bitcoin or blockchain, you do find something which can replicate an investment in the crypto. I can't anticipate much, but we are definitely working on something, on some products which have a crypto as an underlying asset. So anyone who's interested, they just have to wait a little longer and find the instrument they're looking for. Also, Simon, maybe we should remind that the sessions are recorded and they are available in the video library area of the website. And if you have the link, you can share with everyone. They can take advantage of the promo code attached to it and enjoy the 100 free trades for the 3 months on the stock exchange available in the platform.
That's right. And now I have to put that the promo code. There, I'll type it in again. Right.
So I can take advantage of these few seconds to remind our pricing. So everyone can trade UK stocks at a flat fee. So regardless of the amount traded, which is £2.95, and also US and European stocks at a flat fee, which is $3 or €3.95. The same charge applies to ETF on any of the exchanges. And obviously the first 3 months or the first 100 trades are completely free of charge when joining on the Fineco platform. We do not charge any administration cost or any inactivity fees or platform fees. So the account is 100% free of charge.
Ashok's just asking about limited stock offering for UK stocks. You know anything about that, Antonio?
Well, limited means we do have something like 2,500 stocks and ETF on the LSE listing. So there should be plenty of offer.
Yeah, Ashok, I'm not sure which ones you're looking for. Perhaps a smaller market. Some of them might not be there.
Yeah,
okay.
There is the AIM segment of the LSE. There is the FTSE 100, the FTSE 250. So no, there is no minimum amount to open the account. Actually, you can keep the account unfunded because you will receive no charge. So if you just open the account and not use it, you will not be charged anything. So you can open the account and look around, play with it, use the tools available. We also have obviously free news, free market data, the stock screener, which Simon was showing, and the platform. Everything is included in the package, free of charge.
Yeah, it really is a sort of one-stop shop. And don't forget, you get to keep your bank accounts there as well, should you wish to do that, and get a pound debit card and a euro debit card, something that I found very useful, of course, all under the one roof, under the one password. So it's great. But that's the thing to do. Just to if you can open the account up, you get, there's no limit on the amount of, it's not a week's trial or a 2-week trial or anything like that, but explore the platform. There's a huge amount of information and tools for you to use. It really is worth it. We're back on the 23rd of this month for the 3rd installment. So if you can get your account open, it should be done within 1 or 2 days, provided you've got your tax reference, a mobile phone, living in the UK. It's very simple. All the help desk staff are very efficient, and it happens very quickly. Has everybody learned something tonight? I'm hoping the answer is yes. I think we've just run over by 10 or 14 minutes as we normally do, but I think we should probably start to draw it to a close there. So my big thanks to Adam and his furry friend who's come and said, right, you talked enough, Adam.
Not enough attention. Yeah.
Walkie time. I think I'll be doing that myself shortly. So thank you to Adam. Thank you everybody that's here. Hope you've enjoyed it. Do get in touch with us. Let us know if you've enjoyed it tonight. Maybe there's some things that we can add in, and let us know what we can do for the next session. Akira, no minimum amount to open an account. There's no deposit. You don't even need to put anything in to open that account. Have it active. As I say, so you can open it up and just use it as a free trial. No obligation at all. So thank you very much. Thank you, Antonio, for assisting us again tonight, representing Fineco. Always good to have you. We enjoy these events. Hope you enjoyed it and learned something. So from us all, goodbye, good night.
Good night. Thank you very much.
Good night.
Bye-bye.